Hello everyone. Today I will give you the revision session for topic 1, which is introductions to financial management. So before we start the first content of our first topic, I would like to focus on the learning outcomes for this topic. So in this topic, first of all, we will talk about what is the meaning of financial management and how many types of financial management. So we have two types of financial management: personal financial management and business financial management, in personal context and in business context. Second thing we will talk about, which is business. Of course, we're going to focus more about the business financial management in more business context. So in that business context, we will talk about the types or the form of business. So we have three types of businesses, which is sole trader, partnership, and corporation. And third thing, we're going to talk about the structure of corporation. So in corporation, like we have a top management, middle management, and bottom management. So that structure we're going to talk about, that structure more about the finance department, more about the financial information and transactions in the company. How many people involved and whoever is involved in that financial activities, what are the roles and responsibilities of that particular person. So that is about the structure of organization. And then later on, next we will talk about the what is the objective of company, which is not profit maximization, of course, it's maximization of shareholders' wealth. So that's when we speak about how does we maximize the shareholders' wealth. So, and later on, we will talk about the business ethics. So which activities consider as unethical behavior in organizations. So we'll talk about this unethical behavior. Then after ethical behavior, we will speak about the managerial finance function relation with economy and accounting. So relations between finance and economy, and finance and accounting. And then next we will talk about, which is the last learning outcome. In that learning outcome, we will talk about the corporate governance. Right? So what does it mean, corporate governance, and why we should have a corporate governance? In their corporate governance, we will mainly talk about the agency problem. Right? So we start with the first learning outcome, which is meaning of finance. So the first one is a meaning or introductions of financial management or introductions of finance. So in order to understand financial management, we need to understand the meaning of finance. Alright? So finance means the amount of money that we need to start and run the business. That's called the finance. And arranging that finance, it's called financial management. How do we use finance? Alright? Of course, how we raise money, how we use money over the period of time, that's called the financial management. As I said that financial management could be described or could be divided into two parts, which is personal point of view, right, or personal financial management, and of course in business context. All right, and here we're going to focus more on the business context. Because personal finance, probably you're going to have another modules that you're going to learn about personal financial management. How does people arrange their personal finance and insurance and medical expenses and all that, right? So here we're not going to talk about the personal financial management. So we focus more on the business financial management. All right. So before we move on to the business financial management, here we have to understand what is the meaning of business. Right? As I explained in the class, business involves the trading activities to make money. All right. So we buy and sell product and services in order to make money. So that we buy product to sell it. That's called the business process. All right. If we buy product to consume it, you consider as a consumer. So it's nothing to do with the business. All right. So in business, you buy to sell in order to have money, to make money. So that's the meaning of business. So here we have three types of business. We have a sole trader. All right. Sole trader means business done by single person. We call it sole trader. Then we have a partnership. Partnership means business done by minimum 2 people, but maximum, there is no any particular limit for maximum number of partners, but according to Corporation Act, the maximum number of partners should be 50. It shouldn't be more than 50. All right. So 2 to 50. This is the range of the partnership. But practically, of course, we're not going to have 50 partners in one business, because we're going to have 50 partners in the business. Our profit sharing going to be very, very small. So it should be reasonable amounts, depends upon how big is that business, right? How much capital requirements is that business, and capital contribution by the individual partners. So different factors affect to determining the numbers of partners. All right, so this could be like 4, 5, 6, or 7, 10, something like this. And the third type of business is called corporation. Right. Now, what does it mean, corporation? Corporation, of course, is different than sole trader and partnership. So, corporation means it's a separate legal entity with a group of people, right? With a group of people, and that group of people objective is to make money, right? That's called a corporation. So here we have to understand what is the meaning of separate, legal, and entity. Separate means business, which is company, and the owner of business. They are not same. They are separate. Right? It means the owner's personal income and expense is not a company income and expense. Alright? If company has any kinds of expenses, that expenses will be offset from the company income, which is revenue. So that's why sales minus cost is profit. So that expenses will not be paid by the owner of the business. Alright? And of course, if owner of the business went out with friends and family for dinner or for something, that expenses will not be written in company accounts, because that expenses has nothing to do with the company transactions. All right, so company activities. So that expenses are business owner personal expense. So the business and the owner of business are separate. All right. Okay. Now legal. Legal means company must have a business license, all right, or kind of certificates you must have. That certificate is issued by the Ministry of Commerce or in simple language by the government. All right, they issue a license. It permits you to do a business. All right, why? You need a license because, of course, in company you're gonna sell stocks in market. All right, so that's why that company is supposed to be a legal company. All right, so in order to prove that that company is illegal or illegal, government issues certificates. All right, so you submit your business plan and government read it and all that. After analyzing your business plan, government decided to issue a business license to the corporation. All right, but on the other hand, sole trader and partnership, these businesses are not separate legal. All right, such as sole trading business include the taxi driving, right? So Uber or Grab. If you are an Uber driver or you use your own car to use for business purpose as a driving, you do not need any kinds of business license. Of course, you need a driving license. It doesn't matter you do business or not. Unlike driving license, you do not need any kind of special license to become a taxi driver. You don't have to take any kinds of approval from the government to start business. Same with the partnership. You're running the restaurants and being partners with someone else. You do not need any kinds of license. I'm not talking about Ministry of Health, right? But you do not need any kinds of approval from the government that allow you to do that business. Right? So you can, whatever business you like, you can start it without taking approval from the government. Right? So in terms of partnership and everything, because in sole trading and partnership business, you're not gonna sell stocks among people, investors. So that's why you're not required to have any kinds of specific business certificates or license. All right. So that's all about sole trader, partnership, and corporation. Of course, apart from meaning, we have some advantages and disadvantages of sole trader, partnership, and corporation. Here we're not gonna go in detail of sole trader, partnership, and corporation advantages and disadvantages. So all these advantages and disadvantages has been covered in your teaching. So you can have a look at your slides, your textbook to know about the advantages and disadvantages of businesses, different kinds of businesses. Right. So that's all about your meaning and types of business. All right. Now we understand meaning and types of business. Now we have to understand, we know the structure of sole trader and partnership. All right, structure is not so big and complicated, unlike corporation. All right, corporation structure is different because the size of corporation is much more bigger compared to the sole trader and partnership. All right. Okay. So here we have to understand what is the structure of corporation. I'm going to talk about very general structure. All right, I'm not talking about the structure for each and every corporation. I'm just talking about the very general structure. So in general structure, of course, we have shareholders, the person involved in controlling the business. We have a board of directors. After board of directors, we have a CEO or executive directors. Under CEO or executive directors, we have a different head of the departments. Could be head of human resource department, head of marketing department, head of finance department, head of IT department, so on. But here we're going to focus more on the finance. So head of finance department in large corporation is called CFO. CFO stands for Chief Financial Officer. Right. So we have, of course, we have shareholders, board of directors, then we have a CEO, right? And we have various kinds of people or head of the departments, they comes under CEO. So here I'm going to talk about only CFO. Stands for Chief Financial Officers. So Chief Financial Officer is the person who is responsible for all the financial activities, transactions, involvement, planning related to finance, right? So Chief Financial Officers, there are two activities or two managers comes under Chief Financial Officer. I'm talking about large organizations, not small and medium companies, right? So the people comes under CFO or activities involved into CFO is a treasury, right? And another one is financial controller. So here I'm talking about financial controller first. Financial controller responsible for two kinds of activities. First is related to accounting, right? Recording financial transactions in company accounts, right? Not only recording, of course, presenting as well among users, but before presenting we have to audit, right? I mean, we have to invite auditor to audit. And another one is any kinds of taxation issues. Either it's a corporation tax, either it's a capital gain tax, either it's a value-added tax or sale tax, carbon tax, any kinds of taxes that government has obligations to pay, right? So all this accounting and taxation activity comes under financial control. And another side of CFO responsibility is treasury. In simple language, the meaning of treasury is cash, related to cash transactions, right? Cash activity, cash-based activity. So the first one is a cash and credit manager or cash and credit activities. What does it mean? It means company require cash for daily basis, right? So we need cash for day-to-day and regular activities. So all such kinds of cash management will be done by the treasurer or CFO. Second thing is credit activities. Now what does it mean, credit activities? Credit activities means when companies sell products to the customers, company has to decide that to whom company going to sell product on credit, to whom company going to sell product by cash, right? So if company is selling product on credit to customers, how long will be payments period for the customers? So that kind of decisions will be taken care by the CFO or treasurer. Second one is capital expenditure activity. All right. Capital, you know that company needs capital to start and run over the business. So how we invest that capital, right? So that kind of investment or investing decisions will be taken care by the treasurer. Next one is fundraising activities. All right. Which options we have available to raise money. So this topic we're gonna cover in our topic 5. So in topic 5 we're gonna learn that which options company has to raise money. All right, this will be internal, external. If it is internal, we have a short-term, long-term. External again, short-term, long-term. Right, so we will speak more about this one in topic 5. Just remember, fundraising means completely money time to time. So what options company has and which option should be selected, that decision will be taken care by the treasurer, right? And another last one is Forex, stands for foreign exchange. Company involved into buying and selling a product or material from foreign countries. So of course, when we deal with foreign country, we're going to have a transaction in foreign currencies. So due to that foreign currency transaction, probably your profit and loss could be occurred not just because of the price of the product, because of the currencies transactions, currency exchange. So that's kind of activities and kinds of transaction will be managed by the treasurer, who comes under CFO. So that's all about the structure of organization. So after learning about structure, we move on to the next learning outcome, which is goal of firm or goal of organization. Remember, the goal of organization is to maximize shareholders' wealth. All right, that's the primary objective of companies: maximize shareholders' wealth. How we maximize the shareholders' wealth? So there are different factors explain the definitions of shareholders' wealth. But here we're going to connect only one factors that affect the shareholders' wealth directly. The factor is a share price. All right? Share price directly associated with shareholders' wealth. Shareholder wealth means share capital or equity. Equity means residual interest, because total assets minus total liability is equity. Whatever is left, that belongs to shareholders. So if whatever is left, that value increase over the period, that makes shareholders happy. All right. So share price is directly associated with the of course with the capital, with the equity. All right. Share capital. So profit maximization may not be directly involved in maximizing share price. There are different reasons to explain it, that how does we maximizing the shareholders' wealth, or what are the things that attract shareholders. The main things that attract shareholders to make investment in that company, of course, company dividend. The company pay to shareholders time to time. Alright, so if company pay regular dividends or give the high returns to shareholders, of course shareholders are going to be very happy. So they will be more motivated to supply more chunk of capital to the company. Alright, vice versa, they won't be happy if company does not provide a dividend over the period of time. Right, so it has nothing to do with the profit. Why? Because sometimes even though company having a bad time, means company not having a profit, still company arrange their finance or money to give dividend to shareholders. That's the example of the best financial management. Even though in your financial crisis situation, you try to keep your shareholders happy. Alright? So that's the ideas behind a company or corporation's objective, which is shareholders maximizations. Right? So that's all about shareholders maximization. So here I want to summarize it: shareholders maximizations by connecting with the financial manager or financial planner. So financial manager is that person involved in taking important financial decisions in organizations. So of course, when financial managers, they make any kinds of financial decisions, they always consider risk and return. Alright, so of course, as we know that high risk, high return, low risk, low return. So after making any kinds of investment or investing decisions, they consider the risk factors associated to that investment and the return we're going to get it from that particular investment. So they consider risk and return factors before making an investment. So if that investment maximizing the share price, all right, we choose that option. Unlike investment does not maximize the shareholders' wealth or share price. Right? So that's the ideas behind shareholders' wealth. Now we move on to the next, which is a business ethics. All right. So business ethic represent the standard conduct applied in business. All right. So business should be run in the more legitimate way. This is more about the principles and the morale that we required, or like kind of I would say that our intention to run the business. All right. Our intention is to be more fair, more clear, more transparent to the customers and all users. Right? So that's the main ideas behind the business ethics. But in real world, that things does not happen. Why? Because of the people behavior. People attract to something which is easy making. Right? So it means if people get the opportunity to do something bad, they take that opportunity to make very quick money. Doesn't matter that money is coming from legal way or illegal way. If it's coming from illegal way, that's breach the ethical standard. So it means they involve in kind of some unethical activities. So here I'm going to give you some examples of unethical activities or unethical behavior of the people that they adopt in different situations, right? So the first example is a creative accounting. All right. In simple language, creative accounting means change the picture of real numbers into fake numbers to make financial statement more I would say that beautiful. All right. Another way to explain creative accounting is the window dressing. All right. So like let's take it out debts from the financial statement. Right. If the debt level is down in your balance sheet, of course, that looks much more better than the financial statement or balance sheet with the high debts. All right. But why are you doing so? What is the reason behind to take debts out? Of course, attracting the potential shareholders. But keep in mind that if whatever actions we are taking, if that action is going to take any kind of negative impact in short run or long run on shareholders' investment, that means that actions considered as a creative accounting, right? Change the numbers, manipulations, or play with accounting numbers in order to make financial statement more attractive. All right. So that's an example of creative accounting. Next one is earning management. All right. Earning management means when management they focus more on their personal choices and personal benefits rather than they act in the best interest of shareholders. They're supposed to act in the best interest of shareholders because the objective of company is to maximizing the shareholders' wealth. Instead of acting in the best interest of shareholders, they think about their personal interests, personal benefits. So that's example of the earning management. So they think about more their pockets. All right, they're making some kind of personal money. All right, so that money, of course, is not legal. It's not really a legitimate way to earn that. All right, so that represent earning management. Next one is insider trading. According to Security Exchange Commissions that basically control over all the listed company in US. According to the Security Exchange Commission, insider trading is illegal. So what does it mean, insider trading? Insider trading means whatever informations we have, company is supposed to deliver that information in the market without using it. Because if you are using informations first before supplying to the markets. So that means that information will be secondary. All right, and of course, if information is old, that give very negative impact on the efficiencies of market. All right, so market not going to be efficient if information is not fresh, but information is not directly delivered to the people. So if company is using for their own personal purpose and insider purpose, right, and then they deliver information in the market, that's not right. All right, so that examples of the insider trading, like as in the class, I give the example of Mill company, the CEO of Mill company, for example, going to have some collaborations with some international partners. But without giving that information in the market, they use that information for personal purpose, buying share the company price, and they deliver that information in the market, and the price goes up, right? So that's the example of the insider trading, and which is considered to be illegal, right? So it's a crime to do insider trading in that company, right? Next one is bribery. Right. There is nothing to speak much about bribery. You're giving bribe, right? So bribe means we don't have any evidence of transferring of funds, evidence or the legal way to transfer, legal reason to transfer the funds. All right. So that's called the bribe, right? And the last one is fraud. Fraud means cheating customers, cheating employees, or doing anything wrong, such as using company assets for personal purpose. That's also example of the fraud, right? So of course, fraud give negative impacts on the firm's growth, for performance, and of course, fraud also considered as an unethical behavior. Right. So maybe there are so much more examples of the unethical behavior, but there are just few examples for you to understand it. So the idea is that we should avoid all these kinds of behavior to encourage business practice. Right. So that's all about ethics. Now we move on to the next one. Next one is a managerial finance function. What is the functions of finance in organization? These things we already talked about when we discussed about the structure of organization, roles and responsibilities of CFO, who's involved in CFO, like as treasurers or financial controller. Treasurer involves different kinds of activities such as cash and credit activities, foreign exchange transactions related activities, capital expenditure related activities, fundraising activities, and another side of CFO activities involve financial controlling activities, including accounting and taxations, transactions related responsibilities that we already discussed. So that's the meaning of finance functions. All right. So here we're gonna connect finance functions with accounting and with economy. All right. So we talk about accounting relations with finance, right? Remember, in class I explained you about accrual, right? So accrual is a base of accounting. Whatever transaction we record in company accounts, we always keep in the base of recording is accruals, all right? So it means something that you already earned, but you haven't received. Even though you haven't received it, you will record it in company accounts, all right? But finance is different. Finance means if something you haven't received, that does not consider as a finance. So finance is mainly about the cash. What does it mean? For example, we go to bank to borrow money, right? If bank lends you money, you receive, right? That considered your finance, right? Bank did not lend you money now, that will not consider your finance. But accounting is different. You already sell product to the customers. You haven't received money yet, but still it will be recorded in company accounts. All right, it will maximize your revenue or profit. All right, and the customer will pay you. Of course, you will record cash. All right, but you already recorded before when you didn't receive the cash even. So that's the meaning of accruals. So that's the difference between accounting and finance. Finance is mainly about the cash based. Right? If you don't receive the cash, it will not be recorded in company accounts. Right? So what we do in accounting and what we do in financial management. In accounting, of course, we collecting and presenting financial data in report or in statement. That's called financial statement. All right. On the other hand, in financial management, we analyze risk and return of particular project or investment before making investment. All right. We evaluate risk level and return of that particular investment. That's called the finance or financial management. Right? Another one is economics. Right? Economics mainly focus more on the cost and benefits analysis. It means if our cost is lower than benefits, that means our economic decision is good. Alright? If cost of that particular decision is higher than the benefits we are taking from that particular decisions. If your cost is higher, your economic decision is not good. So the idea is that in company we have a finance economic decision means if the benefit of that particular investment is higher than the cost of that investment. That's called the good economic decision. So that's the relationship between finance and the economic, right? So that's all about managerial finance function, right? So we move on to the next one. So one thing I forgot to talk about managerial finance function. In managerial finance function, I forgot to talk about the decisions that financial managers they need to make. They have to make two types of decisions. One is investment decision, and another one is the financing decisions. Right? Investment, as I explained in the class, investment means buying assets. Right? And buying assets means investment. Right? So we have two types of assets here. Fixed assets and current assets. The fixed assets and current assets you already studied in your previous subjects, which was financial accounting. So here I'm just going to explain you that financial manager involved in investing decisions. So it means which assets we should buy or which assets we shouldn't buy. Alright? So how to determine it? These things you're going to study later on by studying different methods such as net present value methods that teach you how to make investment decision, or accounting rate of return, payback period method. We also call them investment appraisal methods. We will study all this kind of methods that help you to make a decision. So the idea is that financial managers is involved into making a financing decisions. Investment decision. Now, financing decision means should we choose that particular options to raise money or not, or do we have any other better options than these options? So that decision is called the financing decisions, right? So that investment and financing decision, you will learn these two different topics throughout this course. All right? So that's all about decisions that financial managers require to make it. Now we move on to the last learning outcome for topic 1, which is corporate governance. So now we move on to the last topic, last item, which is corporate governance. So corporate governance means law and the policies related to company directions and company control. Alright, so in simple language, we can say that corporate governance is that how does company should be run, and companies talk about company directions and company controlling. So now I'm not going to speak much about Sarbanes-Oxley Act, which is 2002 after the Enron collapse. So I'll focus more on the main ideas of corporate governance or any kinds of recommendations that how should company run and problems and conflicts related to the corporation. So here I'm going to talk about agency problem. Agency problem means when there is a conflict. So now we move on to the last content, which is corporate governance. As I said, that corporate governance means kinds of law, policies, tells about company directions and company controlling. Or in other words, we can say that corporate governance provide the operating guidelines that how company should be run. So instead of talking about some recommendations of corporate governance that I only talked in the class, so here I'm going to talk about the agency problems. Agency problem is the problem which normally happen between principal and agents. So what is agency problem? Agency problem represent the conflict of interest. Right? Conflict of interest means principals. Principal and agent. Principal represent shareholders and agent represent the director or CEO. Right? So there is a conflict of interest between shareholders and directors. Shareholders want that company should be run in the more legitimate way. On the other hand, agent doesn't want to work in the best interest of shareholders. So that's why they're going to have problems and issues. If there is a conflict of interest is very high between principal and agent, agency gap going to be very large. So means company not going to achieve its objective, company directions will be in the wrong way. So that's called the agency problem. Right. So what is the solution of agency problems? How agency problems could be solved? Agency problems could be solved by providing incentives to the shareholder, to the agents. So incentive, of course, that incentive could be a performance based. Alright? So it means if company is performing good, performing means, of course, the associated performance with the shareholders well. Right? If that performance maximizes shareholders' wealth, directors' incentives will be high. Alright? So it means directors is working in the best interest of shareholders, because at the one time, directors is working hard for a company to maximize the shareholders' wealth, and of course, that hard work is also providing some kinds of personal benefits for the shareholders, to the directors. So that's why director will be performed in the best interest of the shareholders. So that's all about the topic 1. So here we stop topic 1. So before we start, I want to quickly summarize the topic 1. So in topic 1, first of all, we talk about what is finance, what is financial management. We focus more on the business financial management, and then we learn about what is the meaning of business, types of business, sole trader, partnership, and corporations. Then we talk about the structure of organization, start with shareholders, board of directors, CEO, and mainly focus on the CFO. So CFO roles and responsibilities, including treasury activities and financial controlling activities. Then later on, we talk about the goal of firm or goal of organization, which is maximizing shareholders' wealth. Right? Then after that, business ethics. We talk about different kinds of unethical behavior, including creative accounting, earning management, insider trading, fraud, bribery, so on. Then after that, we talked about the relations between finance with accounting and economics, right? Economy and accounting making relations with the finance. And then next, we talked about the activities or decisions that financial managers they need to make. Financial managers involved in making investment decision or investing decision and financing decisions. All right. Investing decision, of course, including assets, and financing decisions include total liability, current liability, and fixed liability. All right. And the last, we talked about just corporate governance, operating guidelines of company directions, and company controlling activities. All right. So here we talked about focus mainly on the agency problems, agency issues, conflict of interest, right? Agency gap. If they're not going in the same directions, they're going to have a agency gap, right? And then some recommendations that basically minimize the agency gaps. So one of the recommendations is the performance should be incentive based, working better, good for shareholders, and at the same time giving some personal benefits to the directors. So it's like it's careful to narrow or simple, right? So that's all about topic 1. Thank you very much.